Very good evening to all the attendees. Hello, everyone, and welcome to today's session on overview of UAE Corporate Tax. So before we start, let me introduce you to today's speaker. Speakers today with us beside me are Jaikumar Tejwani. Jaikumar Tejwani is an international tax specialist and corporate tax partner based in Delhi. He is a chartered accountant and holds 30 years of experience. He is also a regular speaker on international taxation, direct taxes, NRI, and FEMA matters. Welcome, Jaikumar Tejwani, sir. Bhupendra Mantri, sir. Bhupendra Mantri is based at Jaipur and is our tax and audit partner. He is also a chartered accountant carrying more than 20 years of experience. He also served as a member of AASB and various study groups constituted by ICAI. And I am Karan Mutneja, based in Dubai, originally from India. Currently, I'm managing UAE and Middle East operations. So before we start with the presentation, I would like to highlight some of the housekeeping remarks. So this session is being recorded and will be shared with you after this session is over. The participants are encouraged to send their questions during the session, and we will try best to answer them during Q&A session. If you are unable to hear us, please make sure that your audio is connected by clicking on the communication tab. Alternatively, you can try connecting through computer or by phone. Today's session is based on the Federal Decree Law number 47 of 2022. We recommend to wait for the executive regulation and other guidance to be released by the authority before you take any decision for your business. UAE Corporate Tax. So recently, we know that there are a lot of changes and transformation is being happening in UAE. And especially if you know that since 2018, there are a lot of transportation. In 2018, VAT was introduced. In 2019, economic substance regulations were introduced. 2020, anti-money laundering were introduced. And now we are with UAE Corporate Tax, which were recently released on 9th of December, 2022. So today we are here to discuss on overview of UAE Corporate Tax. I would like to highlight a disclaimer here that currently only the federal law has been released. There's a lot of more clarity that will be coming with the executive regulation, cabinet decisions, and public clarification, which will be released by department from time to time. And we at Prospective Tax Consultant will make sure that you all are being updated as and when any updates are released by the Federal Tax Authority. I could see a lot of participants are here, and I could see a lot of them are from UAE, a lot of them are from India. Many of them are already from accounts background, but there are a lot of other participants who looks like they are not very familiar with the UAE laws and regulations. So we have kept our presentation in a way so that it could be easily understood by the management and decision makers as well. So just to give you a brief introduction on UAE Corporate Tax, before that, I would like to highlight on the Constitution of UAE. So UAE is a constitutional federation, and on 2nd of December 1971, the UAE was declared as an independent, sovereign, and federal state. The UAE comprises of 7 emirates, which includes Abu Dhabi, Dubai, Sharjah, Ras Al Khaimah, Ajman, Al Quwain, and Fujairah. UAE Corporate Tax is a central tax, and that will be applicable on all the emirates that we have mentioned right now. Currently, we talk about what are the taxes and compliances which is applicable. So currently there is indirect tax, which is value-added tax. This indirect tax is collected from the customer, and it is the ultimate consumer who bears the burden of the taxes. The direct taxes, which is going to be implemented from 1st June 2023 onwards, This is the tax levied on the net income or net profit of the corporates and other businesses, and the burden of payment of the corporate tax stays with the business owners. And there are also emirate level taxes, which emirates at their own discretion may impose taxation on certain business segments, including extraction of UAE's natural resources and certain non-extractive activities in the form of royalty, taxation, or fee. I would like to highlight some of the contents at glance that our experts will be throwing some light on that today. So we'll be discussing on UAE corporate tax law at glance, taxable person and corporate base, exempt person, exempt income, free zone persons, tax group, relief and deductions, payment and refund of corporate tax, TP provisions, and GAR provisions. So just to give you a glance of the UAE corporate tax, it was introduced under the Federal Decree Law number 47 of 2022, which is taxation on corporations and businesses. This law was released on December 9, 2022. It consists of 20 chapters and 70 articles wherein the provisions of complete UAE corporate tax are being explained. Today, as a summarized level, our speakers will be covering major articles, which gives you a broad background of the UAE corporate tax. So just to give you a UAE corporate tax timeline, on 31st of January 2022, it was announced by the authority that federal corporate tax law will be released, and some FAQs were also released that time. There were release of public consultation document on 28th of April 2022, the glimpses of which were already shared with most of the attendees earlier. But the public consultation and the decree law that has been released recently, there are few variances that will be highlighted during the presentation as well and will be shared later stage as well. So there are few differences which were there on the public consultation vis-a-vis federal decree law. And there are certain figures and statements which were mentioned in the public consultation, which is yet to be confirmed by the department via cabinet decisions and executive regulations. 9th of December, finally, UAE Corporate Federal Law was released by the department and with more comprehensive FAQs, which were shared earlier as well. Coming to the taxable period, so corporate tax will be levied on the first financial year of the companies, falling on or after 1st of June 2023. To give you an example, let's suppose say any of the company following a calendar year, which is 1st of January to 31st of December. On that company, the first year for corporate tax will be 1st of January 2024 to 31st of December 2024. Now, I would like to hand it over to Jay Kumar Tejwani, sir, to take it forward from here.
Thank you, Karan. Thank you for giving a very beautiful description of what we are going to cover today. And good evening, all the participants. And, you know, I'm feeling so happy that a large number of people are there to attend this webinar. Before I start, today's session is just an overview of what the decree law under 20 chapters and 70 articles has laid down. Starting mid of January, January of 2023, we are going to have detailed 6 sessions covering the tax law along with the regulations and more details. So let's start with the very basics as to what is the definition of a taxable person and what are the corporate tax base. So Article 2 and Article 3, they talk about the persons who are liable for taxation, and Article 3, it gives us the corporate tax rate. Article 1, my friends, is very, very important for all of us to refer because it gives us comprehensive definition. And the definitions, they form integral part of the law. Okay, so let's go to taxpayer. Number one, any individual and juridical person who is carrying on the business in UAE shall be liable for the corporate tax in UAE. Currently, the limits are not yet confirmed, but going by the limits which were given in the public domain or in the public documents, which is also the VAT limit. So 0% for taxable income up to AED 3,375,000. There will be no taxes. Over and above 375,000, there would be a tax rate of 9% on the taxable income. So this is about individual and juridical persons. Juridical persons, as we all know, means the persons who are non-individuals or the legal entities which are registered, incorporated in UAE. Second taxpayer is the qualifying free zone persons. There would be no taxes, 0% on the qualifying income. What is qualifying income? We are going to discuss the later part of our presentation. And for qualifying free zone persons, the applicable CT rate would be 9% on the taxable income that does not meet the qualifying income definition. So, as an example, catering to taxpayer number one, if a business has earned or a person has earned, so person here means the individual, the juridical person, and the free zone qualifying persons as well. So if a business has earned a taxable income of 400,000 in a given financial year, what will be the UAE corporate tax? Very, very simple. That first 375,000, assuming that cabinet decides on this figure, there will be a tax liability of AED 0. Amount exceeding 375,000, which is 25,000 AED, there would be a tax liability at the rate of 9%, which amounts to AED 2250. Thus, the UAE corporate tax liability for the relevant year will be AED 2250. Of course, regulations, procedures, and rules will be announced a little later. Maybe we can move to the next slide. And now I'll be referring to Article 11 and Article 12. Very, very important articles again, which defines who are the taxable persons and what kind of the corporate tax base do they carry. A taxable person shall either be a resident person, a person who is resident of UAE, or a non-resident person. So a person who is resident and who is a UAE juridical person, including a free zone person, his worldwide income will be taxable in UAE. This is in line with the taxation which happens worldwide, wherein any juridical domestic person is always liable for worldwide income. Another category of taxable person is given that where a foreign juridical person, so foreign juridical person means a company or a person who's registered outside UAE, but his business is controlled and managed from UAE. For example, a company has registered themselves as a UK company, but it is completely managed and controlled from UAE by the UAE person. In such case also, the foreign juridical person will be considered as a resident, and worldwide income becomes liable for taxation in UAE. Third, taxable person and corporate tax base, Article 11 and 12. Any natural person means a person who is not a juridical person per se, who is carrying on business activity in UAE. His worldwide income is taxable to the extent it relates to the business or business activity that is conducted by such natural person in UAE. So please read these three categories again. Very, very important. So any person who is resident of UAE, worldwide income is taxable. Any foreign juridical person whose business is controlled from UAE, again, the worldwide income becomes taxable. And natural person who is carrying on business or business activity in UAE, his income worldwide will be taxable in UAE to the extent it is related to or conducted by such person in UAE. And as far as non-resident persons are concerned, if any person includes natural as well as juridical persons, if a non-resident has a permanent establishment in the UAE, what is permanent establishment? We are going to talk about it later. So taxable income which is attributable to such PE in UAE will be liable for taxation in UAE. Second category of non-resident income, the person who is a non-resident but is deriving some state source income. He is deriving income of a business nature from UAE. Then such UAE source income will be liable for taxation. Only such state source income will be liable for taxation in UAE. And third, more or less related to E in UAE, any non-resident has a nexus in the UAE, any kind of a business nexus, any kind of a business connect. The definition is will be discussed later. So any connection in the UAE, again, the taxable income which is attributable to such person in the UAE will be liable for taxation. So this is what the difference is between the resident and the non-resident. Yeah, next slide. Karan, can we increase it to maybe it's currently 79? Yeah, maybe you can increase it, the view to a little bit.
Yes, sir.
Yeah. So what is permanent establishment? As we just mentioned, that a non-resident having a permanent establishment in UAE will be liable to tax in UAE to the extent the income is attributable to UAE. So Article 14, very important here, it defines permanent establishment. It says a non-resident person has a permanent establishment in UAE in any of the following conditions. Number one, where a person has and habitually exercises an authority to conduct a business or a business activity in UAE on behalf of a non-resident person. In OECD language, we call it as dependent agent. So a foreign entity has identified a dependent agent or a person and given him the complete authority to conduct a business or any kind of an activity on behalf of the non-resident. Such dependent persons would be referred to as permanent establishment. Similarly, where there is a person who has any substantial form of nexus in UAE, they may also be treated as permanent establishment. The cabinet is yet to come out with more details on bullet number 3. Bullet number 1, very important again, where a non-resident has a fixed or a permanent place of business through which it is conducting its business activity in UAE is also part of the permanent establishment. So example, a foreign company having a branch office in UAE, such branch office will be a permanent establishment. Or a foreign entity having a project office in UAE, such project office will be would be in the nature of permanent establishment. A consultancy, management, accountant, advocate, CA firms having some kind of a fixed base in UAE, which means that they may not have taken their own license, but they are working along with others. They would be constituted as having permanent establishment in UAE. Further, the following. So generally, as far as PE definition is concerned, we are guided by the OECD guidelines, which are given under Article 5 of the 2019 OECD Model Convention. And PE further includes, and this is very important, what it all includes, an installation or structure for the exploration of renewable or non-renewable natural resources. If there is an installation, they are also considered as PE. PE also includes a building site, a construction site, or a place of assembly or installation, or having any kind of a substantial supervisory activities. Even in such case, it would be constituted to have a PE in India, provided it lasts for more than 6 months. So in case a building site construction or supervisory activity is for a period less than 6 months, it would not be PE, but where such projects or activities, they last more than 6 months, they would be constituted as. Next slide. Feel free to put your questions under Q&A. And again, defining what is, dependent agent. So almost the same thing, a person who habitually concludes the contract on behalf of the non-resident person would be a dependent agent. A person who habitually negotiates contract would again be a. So as an example, and this example is very common in UAE in particular. So foreign companies, they appoint generally an agent. And for namesake, it is their own entity. They identify their own people, give them the role of agent. And such persons, they are authorized to habitually conclude the contracts on behalf of such non-resident person. So it could be, say, for example, building a residential unit. So, they could appoint a real estate or a building contractor to build up a residential unit. And these contractors also have the authority to negotiate the contracts with subcontractors, which non-residents may, after just seeing, may just okay it without any material changes. So they are called as dependent agents, and they do categorize as permanent establishment. Okay, so this was the definition of a dependent agent. Article 15, it defines independent agents. Who are independent agents? And independent agents, they are not the permanent establishment. So Article 15 gives the exemption to investment managers. Investment managers, as I just mentioned, they are independent agent when they are acting on behalf of a non-resident person, where please remember, all of the following conditions are met. Number one, the investment manager, they are engaged in the business of providing investment management and brokerage services under the supervision of a competent authority. Who is a competent authority? We are going to discuss. And second, and very, very important, that the transactions between the independent agent and the non-resident, they are carried out in the ordinary course of the business activities of the investment manager, and the transaction is at arm's length price. And third condition, that such independent agents, they receive the compensation which is at arm's length price within the due dates defined in the agreement. And third, investment agents or the managers, they does not act as representatives. So they do not habitually conclude the contract on behalf of non-residents, neither do they negotiate contracts. They are of independent nature. They only do to the extent their own objects provide, to the extent their licenses are defined. And another exemption is Article 16. It is about partners in an unincorporated entities. So okay, there are no open questions so far. So partners in an unincorporated partnership. So as far as unincorporated partnerships are concerned, the entity per se, the unincorporated entity, unincorporated partnership will not be considered as a taxable person in its own right. So while we are doing with the definition of taxable person, unincorporated entity is not a taxable person. However, the partners can make an application to the authority for the unincorporated partnership to be treated as taxable person. But the regulations have not yet come. What kind of regulations, rules, and procedures will apply? But as of now, unincorporated, they are not the taxable persons. However, the partners of such unincorporated persons who are individuals shall be treated as taxable persons. Again, this is something which is very common in UAE, the unincorporated partnerships, and we need to understand that per se, they are not taxable persons. The individual partners, they constitute the taxable person. Next slide. And how do these partners, they get taxed? Assets, liabilities, incomes, expenditure, everything which is part of the unincorporated financial statements, they get allocated to each partner in proportion to their distributive share in the unincorporated partnership. And again, I'll be highlighting what kind of opportunities do professionals get, in such cases. And the taxable income of the partners, very important paragraph again, shall take into account the following: expenditure which are incurred directly by partner in conducting the business of the unincorporated partnership, interest expenditure incurred by the partner in relation to the capital contribution of the unincorporated partnership. Let me clarify these 2 points. So unincorporated partnership per se is not a taxable person, but each partner in the distributive ratio, they become taxable person. So how do we calculate the taxable income of each partner? That we allocate all the assets, liabilities, income, and expenditure in the proportion of the distributive share, each partner. And then we calculate the taxable income of each partner. However, any interest paid by the unincorporated partnership to a partner on their capital account shall be treated as allocation of income, and it is not a deductible expenditure for calculating the taxable income. So if any partner has received interest on the capital, that will not be deductible while he is calculating the taxable income from the partnership form. And also, Bhupinderji will talk about the exempt income. Such income is also exempt in the hands of the recipient. And for calculating and settling the corporate tax payables, again, is very important. So we have calculated the taxable income of a partner. Now, the taxes which are paid by the partnership firm, unincorporated partnership firms, either by way of a direct payment or a withholding tax or foreign tax, that those kind of taxes will also be allocated to the partners in their distributive ratios, and the partners can claim the tax payment against their taxable income liability. Similarly, another very important point to be noted that a foreign partnership shall also be treated as unincorporated partnership for the purposes of this decree law, where all the following conditions are. The foreign partnership, so please note, this is very important. So foreign partnerships, as we just mentioned, they may have a P or something in UAE, but they will be treated as unincorporated. Unincorporated means that they'll bypass the corporate law tax, and the partners will be liable in their individual hands. And provided there are certain conditions which are to be met, that the foreign partnership is not taxable under the laws of the foreign jurisdiction. As an example, in UK, the partnerships, again, it's a kind of a pass-through entity. Partners are taxable there, not the partnership firm per se. So this is also one of the conditions, that foreign partnership is not taxable under the laws of the foreign jurisdiction. Each partner in the foreign partnership is individually taxable with regard to their distributive income. Again, UK, partnership not recognized as a taxable entity, partners liable for taxation on the distributive income. And the ministry and the minister may come out with more such conditions. Next slide. Two more very important definitions. One is of family foundation, defined under Article 17. Here again, authority is given to a family foundation, that they may apply to the authority to be treated as unincorporated partnership for the purposes of UAE Corporate Tax, provided all the below conditions are fulfilled. Again, my friends, this is very important, because family foundation in UAE is again a very, very common concept. They may apply subject to rules, regulations, and procedures which are not yet defined. They may apply for such foundation to be treated as an unincorporated partnership when all the conditions are met. Number one, such foundation is established for the benefit of a natural person, which means that the natural persons are entitled to certain benefits out of such family foundation for their life, maybe towards their living, education, marriage, their retirement, or such family foundations are for the benefit of the public, or it could be a family foundation for both, partly for charity, that is public benefit, partly for natural persons. Second conditions to be fulfilled, the principal activity of such family foundation is to receive, hold, invest, disperse, and manage assets or funds which are associated with savings or investment. And such family foundation does not conduct any activity which may be prescribed by the ministry as business activities, or its assets being held directly by its founder, settler, or so. Family foundation should not be conducting any activities which ministry has prescribed as business activity. Of course, the conditions are yet to be defined. And another very important, which again is a point which is worldwide, the OECD has noted. The principal object of such family foundation should not be to avoid the corporate tax. And so this is about family foundation. Article 20. Karan has already intimated that I am delayed. Let me just finish it off in 2 minutes. Taxable persons income is the taxable income based on your financial statements. So as I mentioned, the taxable income is only about business income, and the business income will be determined based on the standalone financial statements, which are prepared in accordance with the accounting standards of UAE. They are subject to certain adjustments, namely unrealized gain, losses, exempt incomes, reliefs, etc., which we are going to discuss subsequent. And my last slide is slide number 11, Karan. State sourced income. This definition is given under Article 13. That state sourced income is where a resident person of UAE derives any income through a business activity in UAE, that would be called as state sourcing. Where any income is derived by a non-resident person, and the income which is received by him is attributable to a permanent establishment, which we just discussed. So this is all about the state sourced income. Yeah, Karan, so I think I'm done.
Yeah. Thank you, Jay sir, for your insights on taxable person and corporate base. So before we move ahead to another very important topic of today, which is payment and refund of corporate tax, which allows us to understand the computation of tax, I would request Bhupen sir to put some light on exempt person definitions, exempt income, free zone persons, and tax group. So Bhupen sir, over to you. Thank you. You need to unmute Bhupen sir.
Please change the slide. Yeah.
Yeah. Thank you, Karan. Thank you for your invite to speak on the UAE taxation laws. And as you mentioned, I will be dealing with the exempt persons, then exempt income, free zone persons, and tax groups. So now starting with the exempt person, if you look for the Article 4, basically, as the summarized chart says, there are 4 types of persons who are exempt without any approval. We shall discuss them one by one: government entities, government controlled entities, then business entities which are in the business of extraction and exploitation of UAE natural resources, and the business in which are non-extractive natural resources activities related to the non-extractive natural resources entities. And then there are other 4 categories of persons who need to apply to the relevant authority for getting exemptions. And those 4 entities are qualifying public benefit entities, public investment funds, public and regulated private social security and retirement pension funds, and a person wholly owned and controlled by an exempt person. So we shall discuss these exempt persons one by one. First of all, the government entities. So these government entities are basically the federal government, the local government, ministries, government departments, government agencies, authorities, and public institutions of the federal government and or the local department. So they are exempt from the corporate tax, and the provision of this decree law shall not apply to them. But suppose any government entity is doing any business or any business activity under the license issued by licensing authorities, In that case, that business or business activity shall be taxed according to the UAE law. So that will be treated as a separate entity for that purpose. And of course, the government entities can make an application to the authorities to basically have one single entity for the purpose of taxation of these businesses. Now coming to the next slide, that is with reference to the extractive business and non-extractive natural resource business. So basically, the extractive business is the business or business activity of exploring, extracting, removing, or otherwise producing and exploiting the natural resources of the state or any interest therein as determined by the ministry. So this business, and if we go through the non-extractive natural resource business, that is the business or business activity of separating, treating, refining, processing, storing, transporting, marketing, or distributing the natural resource of the state. So any income, any person who is engaged in these businesses is eligible for exemption from the income if these conditions are satisfied. Firstly, the person is directly or indirectly holds or has an interest in the right, concession, or license issued by the local government to undertake its extractive business, non-extractive natural resource business. So local government here means the government of various emirates also, like emirates like Abu Dhabi, Dubai, Sharjah, Ajman. So local government of those respective emirates will also be there should be basically they should be basically giving the right or concession or license to the respective entities. The person is effectively subject to tax under the applicable legislation of the emirate in accordance with the provision of this article. So that particular government should effectively tax according to the respective law of that particular government. Then the person has made a notification to the ministry in the form and manner agreed with the local government. And of course, what has been mentioned in this particular taxation law, the relevant notification, relevant forms, as well as other applicable formalities, compliances formalities will come later on, which will be issued by the respective government of UAE. Then the person's income from non-extractive natural resource business is derived solely from persons that undertake a business or business activity. So this condition also need to be satisfied. Then if a person that meets the specified conditions of this article derives income from both extractive and non-extractive natural resource business and any other business of this decree law. So suppose anyone is deriving income from these exempt businesses as well as any other businesses, then the income derived from extractive business, non-extractive business shall be computed and taxed according to the applicable legislation of the Emirates. And the income derived from the other business, other than these two businesses which are exempt, shall be subject to the provision of this decree law, and corporate tax is required to be paid by such businesses unless that other business meets the conditions to be exempt from corporate tax under the non-extractive natural business of ICPs. So the other business will not get exemption because of if any entity is carrying on any other business. And for the purpose of this article, a person shall not be considered to derive income from any other business where such other business is ancillary or incidental to the business of extractive business or non-extractive natural resource business, and it does not exceed 5% of the total revenue. So such business will be considered as non-substantive business, you can say. And if it is incidental or ancillary, then the income of that business will not be taxed, because that business will not be considered as any other business. Next. Then qualifying public benefit entity. So any entity which is established and operated exclusively for the purpose of religious, charitable, scientific, educational, social welfare, or any public benefit, so that entity will be exempt from tax. Following, these are the basically conditions which need to be satisfied: that it does not conduct a business or business activities which is unrelated to these aforesaid businesses, that is not related to religious, charitable, scientific, educational, social welfare, or public benefit. And its income or assets are used exclusively for the execution of aforesaid businesses, and no part of its income or asset is payable to or otherwise available for the personal benefit of any of the stakeholders. So these are the conditions. If they are satisfied, then only the public benefit entity will be exempt from the corporate tax. Now, the qualifying investment fund. A qualifying investment fund, which has been defined as any entity whose principal activity is the issuing of investment interest to raise funds or pool investors' funds, or establish a joint investment fund with the aim of enabling the holder of such an investment interest benefit from the profits or gains from the entity's acquisition, holding, management, or disposal of investments in accordance with the applicable legislation, and when it meets the conditions set out in the Article 10. And these conditions are, as mentioned in this slide, that it is established and operated exclusively for, it is under the supervision of the competent authority in or outside India, and it has been listed in the recognized stock exchange, and its principal purpose is not to avoid corporate tax. In that case, that qualified investment fund will be exempt from the taxes. Now, coming to the exempt income. So far, what we have discussed is exempt persons. Now, there are certain incomes which are exempt from the UAE tax, and these incomes are the dividend income and other profit distributions. So any dividend and other profit distributions received from a juridical person, that is a resident person, is exempt from tax. And dividends and other profit distributions received from a participating interest in a foreign juridical person is also exempt from tax. So what is participation exemption? Is basically the income. So what is participating interest? Participating interest is basically a 5% or greater ownership interest in the shares or capital of a juridical person, which is referred to as a participation for the purpose of this act. And the following conditions are also required to be satisfied. These conditions are that the taxable person has held or has intention to hold the participation interest for an uninterrupted period of at least 12 months. And the ownership interest in the participation entitles the taxable person to receive not less than 5% of the profits available for distribution by the participation and not less than 5% of the liquidation proceeds on cessation of the participations. And the third condition which is there is not more than 50% of the direct and indirect assets of the participation consists of ownership interest or entitlements that would not have qualified for an exemption if these assets, direct or indirect assets, are held directly by such person. And where a taxable person fails to hold a 5% for an uninterrupted period of at least 12 months, then any income which has not been taken into account in earlier period shall be included in the calculation of the taxable income in the tax period in which the ownership interest in the participation falls below 5%. So that is wherever such condition is failed or is not satisfied, then such income will be taxed in the period in which such participation interest falls below 5%. The next exemption is foreign. Sorry, I think there is some issue in these slides. Foreign permanent establishment exemptions. So a resident person can make an application or can make an election to not to take into account the income and associated expenditure of its foreign permanent establishments in determining its taxable income. And where this applies, a resident person shall not take into account these items in taxable income while determining the taxable income. One is the losses in any of the foreign permanent establishment calculated as if it were a resident person, positive income and associated expenditure in any of its foreign permanent establishments calculated as if it were a resident person, and then any foreign tax credit that would have been available under Article 47 of the UAE taxation laws. And such exemption shall only apply to a foreign permanent establishment that is subject to corporate tax or a tax of a similar character under the applicable legislation of the relevant foreign jurisdiction at the rate not less than 9%. So this condition also need to be seen for the purpose of getting an exemption under the UAE corporate tax. The next exemption under Article 25 is related to the non-resident person operating aircraft or ships. So incomes which are derived by a non-resident person from operation of an aircraft or ships in an international transportation shall not be subject to corporate tax where all of these conditions are satisfied. One is that international transportation of passengers, livestock, mails, parcels, merchandise or goods is by air or by sea. Then leasing or chartering aircrafts or ships used in the international transportations. Then it is in the leasing of equipments which are integral to the seaworthiness of the ships or airworthiness of the aircrafts used in the international transportation. And the next condition is that the resident person that performs any of the activities under clause 1 of this article would be exempt or not be subject to the tax that is of a similar character or a corporate tax under the applicable legislation of country or territory in which such non-resident person is resident. So we need to see that what is the taxability of the resident person who is engaged into the such business in the respective country. If that resident is not subject to the tax, then this particular exemption will be applicable for the non-resident persons. Now coming to the free zone persons. So basically, what I discussed so far is the exempt persons and the exempt incomes. Now, those entities which are established in the free zones, so their income is also exempt from tax. So which income is exempt from tax is the income which is derived from the free zone and not other incomes. So here the tax rate for such free zone persons would be 0% on the qualifying income and 9% on the taxable income that does not meet the qualifying income definitions. So these are basically relevant criterias or relevant conditions where a free zone person will be exempt from the tax. That particular free zone person maintains the adequate substance in the state. So adequate substance in the state hereby means that UAE entities that have earned income from any relevant activity must demonstrate adequate substance in the UAE relating to such activity by satisfying the 3 economic substance tests. So what are these 3 economic substance tests? One is core income generating activity, that is called SIGA test, requiring the core activities to be performed in the UAE. So again, we need to refer to the economic substance regulations of UAE. Then second condition is directed and managed test, requiring the business to be directed and managed from the UAE in relation to the relevant activity. And the third is adequacy test, requiring adequate resources, that is employee, etc. in the state of UAE. Of course, it derives in the second condition is it derives income from qualifying incomes, and it has not elected to the corporate tax. So here, the free zone person have an option to elect or to be subject to the corporate tax itself, as per the article, sub-article 1 of the article 3. So basically, if any free zone person, if they opt for election to the normal tax rates of 9%, then they are not entitled for this particular exemption. And this 9, as and when this applicability of the normal tax rate may be from the tax period in which it has been applied, or it may be from a subsequent tax period. So this is all about the free zone persons taxability under the UAE law. I think this I have covered. Election to be subject to the corporate tax. Now, very important subject is related to the taxability under the of the tax groups. So any resident person which for the purpose of this decree law will be referred as parent company, it can make an application to the authority to form a tax group with one or more other resident persons, each referred to as a subsidiary for the purpose of this chapter, where these conditions are met. One is that these resident persons means the parent company as well as the subsidiary company are the juridical person. Then the parent company holds at least 95% share capital, voting rights, or profits and net assets, either directly or indirectly. And then none of them are in the exempt or qualifying free zone persons. And both the taxable persons are preparing their financial statements as per the same accounting standards, and that is in fact as per the UAE provisions, the international financial reporting standards, and they follow the same financial year for the purpose of taxation laws. So if these conditions are satisfied, then parent company as well as the subsidiary companies can be taxed as a separate tax group for the purpose of UAE taxation law. The parent company and each subsidiary company shall be jointly and severally liable for corporate tax payable by the tax group for those tax periods when they are members of the tax group. So here, basically, application is required to be made by both parent company and each of their subsidiaries to the relevant authority for getting themselves to be a single tax group. And suppose if any existing group is there and some other subsidiary company of that group who is eligible to be part of the tax group wants to join this group, then that subsidiary can also apply to the relevant authorities, of course, subject to the approval of all the other group companies. Any of the subsidiary at a later date can leave the tax group, first with the approval of the relevant authority, and the second one is that that particular subsidiary no longer meet the conditions of eligibility of to be there into the tax group. So in that case, that particular subsidiary company can get the can leave that particular tax group. So this is the these are the provisions related to the tax group. Now coming to the date of formation or cessation of the tax group. So a tax group shall be formed or a new subsidiary shall join an existing tax group from the beginning of the tax period specified in the application submitted to the authority, or from the beginning of any other tax period as determined by the authority. Further, the relevant member of the tax group shall be treated as leaving that tax group from the beginning of the tax period specified in the application submitted to the authority, or from the beginning of any other tax period determined by the entity. Further, the relevant member of the tax group shall be treated as leaving that tax group from the beginning of the tax period in which the conditions as specified under the decree law are no longer met. The conditions like holding of 90% of the share capital by the parent company, or conditions like that they get certain exempt or certain incomes which are from the qualifying free zone incomes. Now, taxable income of the tax group, how to compute? So there is a certain process. There are certain processes that for the purpose of determining the taxable income of a tax group, the parent company shall consolidate the financial results, assets, and liabilities of each subsidiary for the relevant tax period, eliminating transactions between the parent company and each subsidiary that is member of the tax group. So here I would say that generally the companies which are preparing their consolidated financial statements, they consider their all subsidiaries, whether the overall holding of the subsidiary is less than 90% or more than 95%. Less than 95% or more than 95%. All subsidiaries as well as the associates and joint ventures are considered for the purpose of preparing the financial statements of the parent company, consolidated financial statement of the parent company. But here, if we see the provisions, and of course, because of the taxability provisions related to the tax group, the consolidated financial results are required to be prepared by the parent company by including its own financials as well as the financials of those subsidiaries which are member of the tax group. So the subsidiaries which are not member of the tax group may also find place, or will their financial statement will be included in the CFS, but not here. So all companies have to have a different set of consolidated financial statements for the purpose of determining the taxable income of the tax group as per this UAE Corporate Tax Law. So that is a very, very relevant exercise which is required to be done by the parent company and their subsidiaries for the purpose of determining the taxable income of that particular tax group. The relevant provision of this decree law shall apply as the context requires to the tax group. Now there are other provisions related to the unutilized tax loss. So any unutilized tax losses of a subsidiary that joins a tax group, so these are basically pre-grouping tax loss, shall become carry forward tax losses of the tax group and can be used to offset the taxable income of the tax group insofar this income is attributable to the relevant subsidiary. So this offset is allowed of the unutilized tax losses of the subsidiary who basically joins the tax group. And where a new subsidiary joins an existing tax group, then unutilized tax losses of the existing tax group cannot be used to offset the taxable income of tax group insofar as this income is attributable to the new subsidiary. So suppose a tax group is already carrying on certain losses and the new company joins to that particular tax group and that company has income for the tax period, then those losses which are already there of the existing tax group cannot be set off against the income attributable to the newly joined subsidiary company. So, and where a subsidiary leaves a tax group, the tax losses of the tax group shall remain with the tax group. So with the exception of unutilized pre-grouping tax losses of the relevant subsidiaries. And on a cessation of tax group, unutilized tax losses of the tax group shall be allocated, like where the parent company continues to be a taxable person, all the tax losses shall remain with the parent company. And where the parent company ceases to be taxable person, the tax losses of the tax group shall not be available for offset against the future income of the individual subsidiaries, with the exception of any unutilized pre-grouping tax losses of such subsidiaries. So basically, these are the overviews of the provisions related to the tax groups. And of course, it can be better understood by the relevant examples, but within the time given, only the overview can be explained. Here, what one can conclude from the perspective of advisory and consulting on the UAE taxation law, that whether a particular group of corporates having parent company and the subsidiary company should go for the taxation as a tax group, or they should go for the individual taxation of each of the corporates separately. This need to be examined from the standpoint of view of each and every company of a group. So this is all about so far as my presentation is concerned. I would just take one more minute, Karan, that this particular UAE taxation law not only provide the opportunity to the tax professionals, but at the same time, since there are a lot of issues with reference to the maintaining the financial statements as per accounting standards, so those accounting professionals will also have the opportunity to ultimately assess that how an income need to be computed as per these accounting standards. Then comes the audit and assurance people, who are basically there are all fair chances that UAE government will come out with the provisions that the audit is required to be done by the auditing professionals. So audit and assurance is also required to be, audit and assurance professionals will also get a lot of opportunity because of this particular aspect. And apart from that, there are a lot of issues with reference to the internal controls when an entity is required to prepare their financial statements. So those opportunities will also come. Apart from the opportunities which we are talking about, the tax professionals. So I wish that the professionals as well as the companies now gear up for implementation of the UAE corporate taxation law. So thank you, Karan. Thank you for the opportunity. And thanks, Tejwaniji, for explaining us in detail about the corporate tax base.
Thank you so much, Bhupen sir. Rightly mentioned, a lot of professionals are looking forward towards UAE market and a lot of opportunities are being opened up. In the interest of time now, I would request Jay sir to take another very important topic, which is relief and deductions and payment and refund of corporate tax, and then throw some light on TP provisions and GAR provisions as well, sir. Over to you, Jay sir.
Yeah. Thank you, Karan. Bhupendraji, apart from accounting, auditing, tax, the transfer pricing and GAR, So international tax also acquires a lot of importance.
Yes.
And at the same time, understanding of VAT becomes very, very critical.
Absolutely.
I'll, in next 10 minutes, we'll finish off with the relief and deductions. So number one, the small business relief. Article 21 says that if any person is within the threshold limit, they may elect not to be treated as a taxable person. Okay? And somebody who's within the threshold limit, of course, they would, any of the decree law provisions shall not apply. They shall not be applied, not be entitled to any exempt income. They will not be entitled to any reliefs, deduction, tax loss carry forwards, or AP documentation. Another relief which is provided under Article 26 is the transfer within a qualifying group. Qualifying group, as Bhupenderji just explained. So if there is any transfer of assets within the qualifying group, there would be no gain or loss per se, which will be considered as taxable income. Next slide. So I'm not covering what is qualifying. Bhupenderji has already explained it. So next slide, Karan. So similarly, any business restructuring which happens within the same group, there will be no gain or loss. So I'll just read out bullet number 1, which is important, that a taxable person transfer its entire business or a part of the business, which we call it as slump sale in India, to another person who is a taxable person, or he will become a taxable person. And this is as a result of the transfer in exchange for shares or other ownership interests of the taxable person that is transferring. This kind of a business restructuring, no gain or loss needs to be taken into account while determining the taxable income. And similarly, there are certain deductible expenditure given under Article 28. Next slide, please. And we are going to cover all these in our detailed sessions starting from January 15th. Number 1 is interest expenditure. So a taxable person's net interest expenditure shall be deductible only to the extent of 30% of the accounting earnings. And in fact, we call it EBITDA, EBITDA, that is before any kind of exempt incomes, depreciation, interest income, and amortization. So earnings which are before deduction of interest, tax, depreciation, and amortization, interest deductibility will be restricted to 30%. Next slide, please. Very important about no deduction shall be allowed, as Bhupenderji also covered under his exempt income, that in case there is any dividend payment, any kind of a buyback, repurchase of share capital, or reduction of share capital, or there is a capital contribution to a related party, these kind of things will not be considered as deductible expenditure. Article 32 on entertainment expenditure, it says that taxable person shall be allowed to deduct only 50% of any entertainment expenditure in the form of amusement, recreation, or welfare, which are incurred during a tax period. And as you could recollect that in VAT also, entertainment expenditure ITC is not allowed. And Karan, I wish to welcome a lot of participants who are our very honored guests in UAE. I could see a few names here and welcome all of you. Similarly, non-deductible expenditure under Article 33. And for the first time in the world, actually, I would say that Article 33 says that no deduction shall be allowed for specific expenses, such as administrative penalties, bribes. Bribes for the first time in the world tax law is mentioned in any law. Even India doesn't mention about bribe. It says something which is not related to business is not deductible. But, a lot of efforts to UAE to mention the word bribes. Any kind of a recoverable VAT, so where ITC is available, and any donation paid to an organization which is not approved. Such kind of expenses, they are not deducted. Next slide. Yeah. Again, this is very, very important as to the payment and refund of corporate tax. Number one, Article 43, which is very, very important, that the financial statements or any kind of a reporting which is to be done in UAE should be quantified only in the UAE dirhams, AEDs only. Any other currency needs to be converted at the applicable rate, which is set by the Central Bank of UAE. Of course, rules will come in to define what date and what rates are to be taken. Similarly, for the calculation and settlement of corporate tax. So, as in our slide number 1, we calculated the tax of 2250 on an income. It will be settled. Number 1, if there is any withholding tax credit, that will be allowed. If there is a foreign tax credit, that also will get allowed. And any direct payment of corporate tax will also settle that payment of liability. Next slide, please. Yeah, Karan, next slide. Yeah. Next slide, please. Okay, yeah. So let's understand it with the help of an example. So let's look at case 1, wherein there is a taxable income of 10 million rupees or 10 million AD. Tax on this income is 9% of 96,25,000. That is excluding AED 375,000, is 866,250. And there is a withholding tax of 500,000. Of course, currently there is no withholding tax rate which is defined, and we are all waiting for the notifications and circulars to come out if there is any withholding tax. But assuming that there is a withholding tax, so out of 866,250, withholding tax will be reduced to the extent of 500,000. And in this case number 1, there is also foreign tax credit to the extent of 300,000 that also gets reduced. So the balance amount after giving the credit of WTC and FTC becomes the corporate tax which is payable, which in case number 1 is 66,250 AED. In case number 2, again, same income, same tax. Here the withholding tax is 600,000 and foreign tax credit is 300,000. And this is resulting in a refund of 33,750 AED. I need to clarify one thing here, that foreign tax credit under no circumstances will exceed the maximum marginal rate of tax in UAE. So in case in a jurisdiction, the foreign tax credit is 12%, not more than 9% tax credit will be given, which is called the ordinary tax credit. And in most of the DTAs, which UAE has entered with different jurisdiction, the ordinary tax credit method is allowed, which means no refund of foreign taxes in UAE, no carry forward of foreign taxes allowed. Case number 3, same income, same taxes, withholding tax is 500,000. Here the foreign tax credit is 366,250, and which equates WTC and FTC, they equate to the total tax on income. So there is no due. Yeah, next slide, Karan. Now I'm coming to 3 very, very important slides. One is the transfer pricing provisions. And transfer pricing provisions are exactly as per the OECD guidelines and as applicable in the jurisdictions of UK, majorly, and also Singapore, US, India. So more or less, the OECD guidelines have been picked up under Article 34, wherein it says that arm's length principle will be applied for the transactions between the related parties. And the definition has already been explained by Bhupinder, and I'll also be covering the definition again. And according to Article 34, the arm's length must be determined, whether the transactions between the two related parties are at arm's length or not, by determining one or the combination of the transfer pricing methods. Worldwide, they are all same. The comparable uncontrolled price method, resale price method, third is cost plus method, TNMM, that is transactional net margin method, transactional profit split method, and any other method. So out of these 6 methods, one or combination will be applied to determine the arm's length principle. And of course, for determining the transfer pricing method, we have to look into the contractual terms of the transaction or arrangement between the related parties, economic circumstances in which the transaction or arrangement is conducted, the FAR, very, very important, the functions performed by each party, the assets employed, which party is employed, to what extent the assets, the risks which are assumed by the related parties, and the business strategies employed by the related party. So considering all these parameters, one of the methods will be applied, one or more, and then the arm's length principle will be determined. Next slide. And who are the related parties? As we just discussed, again, Article 35 gives a very elaborate definition. So related party bullet 2 is an individual or a legal entity if they directly, indirectly owns 50% or more in another legal entity. These two entities would be considered as related party. Third bullet, where 2 or more legal entities, either alone or jointly, directly or indirectly, they own 50% of the share or control in the other legal entity. So more or less same. Second bullet, individual and legal entities. Second, 2 legal entities. If they are owning 50% or more, they are considered as related parties. A taxpayer and its branch or permanent establishment. Any transaction, again, in US, UK, India, any kind of a transaction which branch carries out will be, it's subject to the transfer pricing. Partners in the same unincorporated partnership, we discussed in details. So any kind of a transactions between the partners, they would all be related parties. Article 35. Article 36 talks about connected persons. So in UAE, connected persons and related parties, they are different. So Article 36 says that a payment or benefit provided by a taxable person to its connected person shall be deductible only if and to the extent the payment corresponds with the arm's length and not otherwise. So who is a connected person? So let me again, so related party we understood, they are independent parties holding maybe 50% or more, either in control, directorship, ownership, or a kind of a branch or a permanent establishment, or partners of the same. They are related parties per se for transfer pricing. But a connected person definition, which is unique in UAE, is about persons. Karan, maybe you can move to the next slide. So connected persons are if any payment is made to the owner of the taxable person, a director or the officer of the taxable person, or to a related party, all put together, they will be considered as connected parties. For example, prospective tax consultant UAE, Karan Mutteja is one of the partners. So if any payment is made to him, that would be payment to connected parties. May not be allowed if it is not at arm's length. Or if there is a company, prospective tax consultants, which is a legal entity, any payment made to the director or officer of such entity, if it is not at arm's length, will be considered as not allowed. Or any related party which we just discussed. Okay. And very, very important article is Article 55. Again, guided by the OECD, transfer pricing documentation is to be maintained very elaborately now. the authority may by notice or through a decision. Of course, these all things will be covered when we take up our detailed sessions, that they may require a taxable person to file. Now, underline the word file, together with their tax return, a disclosure containing information regarding the taxable person's transaction and arrangements with its related parties and connected persons in the form described by the authority. For example, in UK, US, Singapore, India, we have a form called Form 3CAB, which is filed along with the tax return, wherein the complete details of the related party and connected party transactions are given. And in such a form, we do mention whether the transactions are at arm's length, what method is applied while determining the ALM. So similar provision, as I mentioned, that TP is going to be a very significant segment now. Next slide. And we are now going to conclude with bar provisions. Generally, the provisions which are considered as anti-abuse rules. Article 50. So let me read out the first two bullets. Very, very important. That the article applies to a transaction or an arrangement if it can be reasonably concluded that the entering into or carrying out of the transaction is not for a valid commercial or non-fiscal reason. That is, any transaction which lacks substance would be considered as general anti-abuse, or a transaction which is entered to avoid corporate tax, or where the purpose of a transaction or an entity is to obtain a corporate tax advantage or an evasion. So in such a case, if the government or the authorities, they find out a transaction which results or which they think is to evade the corporate tax, the veil could be lifted. And such entities may be brought to the taxation. So this is all, my friends. We are done with the time. Karan has been putting in a lot of efforts to complete it. Anything under question and answers before we conclude? Yeah, Karan, you can take it over from there.
Thank you so much, Jay sir, for the presentation. And we could see there are a lot of questions. We have tried to answer them through the Q&A session. And we'll be answering a few questions which are left maybe after the session. So I would like to just, make one announcement here that we'll be coming out with a detailed session starting from 15th of January onwards, and we'll be posting you the updates on that. So that detailed session will be covering the complete articles of UAE Federal Law and the executive regulations or cabinet decisions released by that time. So I would request you to drop Q&A, your questions in Q&A session. We'll be keeping this meeting on. Those who wish to leave may leave the session. I would like to thank you, all the participants, for being here. Thank you, Jay sir. Thank you, Bhupen sir, for taking out time for this broad overview of the federal tax law. And there are multiple questions, so we'll be answering them on a separate window. Thank you, sir. Jay sir, meantime, I can just take up a few questions which I can see on my screen. And Bhupen sir, I think you have, yeah. So yeah. So there's one question that someone has asked, that his free zone company is driving income from UAE, from his free zone and mainland. So do they need to maintain separate books of accounts, or should they apply for new license in the mainland in UAE?
Yeah, Karan, in fact, I have tried to answer this. Basically, if we see the Article 18(1)(b) of the UAE taxation law, it is specified in a decision issued by the cabinet at the suggestion of minister. So basically, the clarification should come regarding that how to determine the income of taxable income of the qualifying income of the free zones. But however, what I believe is that the separate income or profit and loss statement is certainly required to be prepared for the purpose of qualifying, for the purpose of computing qualifying income of these free zones, if there are incomes from more than one sources. So from qualifying as well as from non-qualifying, because that is the way which one need to actually prepare and compute the income.
I'll just add to it that so as Bhupendraji pointed out, the accounting statements have to be maintained separately. Of course, regulations will come out on this.
Correct.
And following same accounting standards. This is very important. We cannot have both. So correct, Bhupendraji.
So another question that has came from two participants is that, is director remuneration allowed expense for tax calculation? I think you answered this at a later slide. So do you want to add on something on this question, sir?
So sorry, what is the question?
Director remuneration is being allowed as a expenditure for tax calculation?
Yeah, it is allowed, provided it is at arm's length. It is allowed, yeah.
Okay.
If it is abnormal, like in US, UK, Singapore, a lot of jurisdictions, there are certain conditions and parameters defined, wherein if the remuneration or, stuff like any payments to connected parties, if it is not at arm's length or abnormal, then they are disallowed. But otherwise, as a general answer, yes, they are allowed.
Okay. So there's one more question. I think similar question came across which Bhupen sir also answered, that an individual person who owns residential and commercial property in UAE, will the rental income on that properties be taxable or no in the hands of an individual?
So I think Bhupendraji has already replied to this. So if it is his business activity, yes, it will be considered as a taxable income.
So probably what I believe is that this Article 6 of, sub-Article 6 of the Article 11, where they say that the Cabinet shall issue a decision specifying the categories of business or business activity.
Yeah.
So it must be covered over there as and when such directions.
Yeah, such notification is, you're right.
Okay. So thank you, sir. Thank you so much. We'll be closing the session now. Thank you so much, participants, for being here.
Thank you.
Okay. Thank you.